Well, it's a very good morning from him, and of course, it's a very good morning from me. Welcome to my mortgage live stream. It's October. It's the middle of autumn is well upon us now. Of course, we're kind of in the middle of autumn now, aren't we? The leaves are turning. Went out down to Telford over the weekend. Went to my speaking association conference in Telford, and big sort of golfy kind of hotel. Not that I play golf, but it was a big golfy hotel, and the trees were a golden brown colour, beautiful colour, golden and oranges, and just beautiful as we walked along. It was a bit foggy, so you couldn't see too much coming back on the Sunday. So hope all is well with you. Interesting mortgage market. Hopefully you're keeping busy. You're looking at other areas of activity, of course. If you're in the financial services side of things, we've got the great budget coming up, and I've got a little session for you today. If you're new to financial advice, which many mortgage people are, of course, they refer to financial advisors. I want to give you an update on what the budget's going to mean between income and wealth taxation. There's lots of tax, Labour is completely comfortable with taxing the very wealthy, a lot of politics. The fact is that they're going to look at taxing wealth. And take a look at that subject for you as well. And also, because I know you're desperately wanting to know, but the Pensions Act of 2004 is coming up today as well, just to update our boot camps as well with the information. Just want to give you an update on that topic as well. Enough of that. So let's go over to the whiteboard, shall we, and do our first session of the day. I hope you're all right, by the way. You're all well and enjoying the sunshine. It's still quite warm and mild out there, isn't it? So let's pop across. So here's one I prepared earlier, tax we're looking at now, wealth versus income. Now, why am I looking at this? Well, primarily we've got a budget coming up at the end of November, and the Labour Chancellor has said that she needs more money. She does it every year. I think 40 billion is the black hole this time, probably caused by previous incumbents, but there we go. So she's got to fill it, and she's going to fill it through, she's not going to stop spending, so she's going to tax. So that's what we think. But they've talked about taxing wealth as opposed to taxing income, and there's a big difference, and I want to clear that up with you today, because you've over here got income, which is money that you earn, obviously, and over here we've got wealth, which is predominantly assets, things that you own, like shares, property, that sort of thing, assets, gold, silver, all those things. Now the phrase, of course, goes that what you earn versus what you own. So that's a nice sort of phrase here. So what you earn, there you go, versus what you own is the phrase to use here, which distinguishes the two. So let's just take a look at some of these briefly, just to remind you. Income, well, there's all sorts of income, isn't there? There's earnings from salary, there's profit from self-employment. That's all income, is it? That's most people's income, isn't it? You've got dividends from shares. You've got interest, of course, from savings. That's all income as well. You might have rent from property, of course. That's income. Can't disguise that one. The thing about income, though, is it's all very progressive. You've got high net worth rates and percentages. It's very progressive. The more you earn, the more you pay, which is right. Stiff shoulders, all those sort of things. You've got bands. Limiting how much lower income people pay. You've got allowances and all sorts of things. And the kind of taxes, well, national insurance comes into its own, of course. Income tax is key. These are the main ones, aren't they? Don't forget VAT, not on earnings, but people earn and they spend it. So I suppose it could be construed as such. And on the corporation side, of course, you've got corporation tax, which is company earnings. So as you can see, income is quite easy to spot, easy to tax. You just put income tax up, national insurance up. But wealth is a different thing altogether. If you've got wealth, so you might have shares, for example, is a big one. You might have property. You might have other kind of assets as well, gold, physical assets, pension pots arguably come into that as well. If you're saving for a pension, all those things construe as wealth. And they're looking to tax that more in the budget. So what are they going to do differently? Well, first of all, let's see what sort of taxes we've got and what sort of property and assets. Let's take property. That's the first one for you. Let's just put our property in there. Your first property or second property, it doesn't matter. That's taxed massively at the moment. You've got stamp duty, land tax, of course, on buying property. That's been around for a while. You've got capital gains tax, which you pay on second properties or holiday homes, up to a large amount as well. And of course, you've got inheritance tax when you pass this on to people, less various exemptions and nil rate bans. What do I think about doing in the budget? Well, the other tax, which you mustn't forget, is council tax. Council tax is based upon your property ownership value. They're looking at maybe increasing that for high properties, high value properties. They're looking to increase the council tax. They're doing it for second homes all over the UK at the moment. And that's caused a lot of housing bubbles around the coastline to explode, which is not good if you're selling a property. But they're looking to do some kind of wealth tax. Let's talk about, maybe just apply 1% of your value of your property as an annual tax. That's brand new, isn't it? So that maybe homes over 500,000 or homes over 1 million. And in London and the South East, that's quite a few of them. So that's been talked about quite a bit as well. What else have they been talking about doing in the budget, maybe? Well, pension pots is another kind of, let's just put in there, pension pots are another kind of wealth, aren't they? You've built up your savings, you've got it in some kind of asset-backed investment savings pot, and you're going to have that when you retire. Now, the pension commencement lump sum has had a lot of changes, of course, recently. They may be limiting that even further. So that's not good news for lots of people that got big pots. Essentially, it's 25% of your pot, subject to a maximum 260-something thousand. But they might actually reduce that cap even more, which ain't very good, is it, for a lot of people? Inheritance tax was brought in the budget last year from effect of 2027. Your pension pot now forms part of your estate. If you die, it gets passed over to your next of kin, will become liable to inheritance tax, which isn't particularly good if you've got a large legacy to pass on. Of course it's not. What else are they looking to do? Let's have a look at what other wealth taxes we've got as well. Well, the other one, of course, is inheritance tax. When you have a wealth, it passes on to your next of kin on death, and there's inheritance tax payable. We've known that for many years. They might even tinker with the 7-year pet rule, where you have a potentially exempt transfer, gifts and things. They might make that 10 years. That will certainly bring in a bit more money as well. They might get rid of the residence nil rate band. So at the moment, if you've got your own property and it passes on to your kids or grandchildren, less a certain amount, I think 2 million, your estate is worth, that can give you an extra nil rate band to add on to your other nil rate band, giving you 500,000 of nil rate band for a single person. They might get rid of that. Again, that will produce more money as well. Other things they're looking to do, now obviously a big one up here is capital gains tax. Let's put that in there for you. CGT, capital gains tax. Now they increased it last autumn. They might put that up in some way or form. There's talk that they might make it the same as income tax. There you go. So income tax, of course, has bands, progressive taxation up to 45% for high earners with allowances and stuff. They might make it very similar to that, and that will increase the amount of money they bring in. The other one, which I'm certain they're going to do, and that's going to affect a lot of your clients, actually, mortgage advisors or financial advisors, is shares. Let's put that in there for you. Now, shares, let's put shares in there, or unit trust or collectives, whatever you've got your money invested in, outside of a pension fund here, are taxable, unless it's in an ISA, of course. But if you own a share, it pays a dividend, which is pretty much its interest, really, isn't it? The profit of the company is made each year and they pay it out in the form of dividends, and they're taxed at different rates to income tax, quite low rates as well for basic rate taxpayers. Now, okay, if you own shares, that's just a bad thing to do, but a lot of people run limited companies in their own name and pay themselves dividends as well as a small salary. We call those people owner directors, don't we? Now, those people can be hit hard because what they'll probably do here is change the dividend rate to equalise it with income tax. And the basic rate dividends is about 7.5% or something, very low. They'll whack that up to 20%, you wait and see, which will affect a lot of people who pay themselves through dividends as opposed to salary. So they'll be slipping over to PAY and paying salaries from now on. And arguably, that's probably the right thing to do. So lots of changes coming in. You notice what they're doing is they're not touching income. or any form of income tax, they're going to hit wealth tax. So when you hear them talk about it in the newspaper or on the online press or whatever, they're going to tax wealth. That's what they mean. Now, if you've got a client and you're a mortgage advisor, if you've got a customer, client, or the client's got people, parents or whatever, and they're worried about this, the pure fact is that independent financial advisors can help here. A lot of their advice is tax-based. Tax doesn't wag the investment dog, as they call it, but a lot of your investment decisions can be altered to maximize your tax position. You can move stuff about, is what I'm saying. You can maximize your exemptions, your trusts, that sort of things. IFAs can do a lot of good work with somebody to reduce their wealth taxation, particularly inheritance tax as well. So your action then, if you're a mortgage broker, is to get an IFA in your influencing sphere, in your tribe, and then refer your clients, refer them on. If you've got a client that fits the IFA's client profile, then refer them on to the IFA, and you earn yourself some commission, a referral fee if you wanted to. Or it's just giving good advice. Or why not get yourself qualified as an IFA? You can do it yourself then. That's the future for you, by the way. It's much more exciting as well. So that's wealth versus income, what you earn versus what you own. I hope that's been useful for you. Bye. Good. Okay, that's good stuff. Right, that's good news. I'm glad that session went well for you. If you're doing your exams, of course, that's all very relevant, naturally. Your new CeMAP 1 FSRE exam. If you're doing your DIPFA exams, obviously there's a complete taxation and investment module, and a lot of that stuff is covered in a bit more depth, really. It's interesting, isn't it? The whole topic's really, really interesting. So what I'd like to do now then is go on to our next topic for you, our second topic of the day, and that one's, the Pensions Act of 2004, which is really just an update for any of you that are doing your CeMAP, or you have done your CeMAP in the past, because the new CeMAP 1, which is out now, of course, new CeMAP 1 FSRE, covers this topic where the old one doesn't. So if you're doing some proper CPD, then you need to be up to date on this one. So it's worth having a little look at what this one does and see where the implications are. So let's talk about Pensions Act 2004. Pensions Act. Now you might think, well, I don't deal with pensions, so I don't need to know about this one. But actually, there's quite a few connections here for you that we need to be aware of as mortgage advisors specifically. 2004 seems a long time ago. We've been catching up on the IT Crowd on Channel 4. It's a great comedy based around 2006, 2007. It will remind you what the early noughties was all about. Okay, what's the thing about the Pensions Act 2004? Well, back in the day, if you belonged to a pension, so if you had a pension scheme or a pension fund of some description, that pension fund might have fallen off a cliff. There's my cliff. Splash. Let's put a little water down here so you can see where I'm going. I'll do a seagull or two. Give it some authentication. But the whole point was, before 2004, if your pension, your company went insolvent as part of your pension, then it would often jeopardize your pension. And that wasn't good. So they brought in the Pensions Act to stop that from happening, any company going insolvent. So that's the background for you. So what did it do? Well, first of all, get a different colour pen here for you. It told pension schemes, and by the way, these are occupational pensions. These are not personal pensions, occupational pensions. It told pension schemes to adhere to some funding standards. In other words, they had to make sure that they funded the pension in the right way, and they did an annual check of this to make sure they were adhering to the funding standards. Broadly speaking, what they were looking to do here, so let's just draw a little picture here. Let's draw one of those scales of justice, shall we? We like those, don't we? A scale of justice here for you. Dun, 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 dun. There's my scale there for you. Now the scale has got two forks there. I don't know, pretty good picture, isn't it? A balancing act here, because a good pension scheme, this is a company pension scheme, must manage its assets really well. And here are the assets that the pension scheme manages, the funds under management. That's obviously the money that's got in the pot, the money that's coming in from the company and from employees as well. That, in a sense, has got to be better than the liabilities. That's the key. And the whole point about funding standards, it made sure the liabilities weren't more than the assets. Liabilities, by the way, for a pension scheme are current and future pensioners. Again, future. Let's put it in there, pensioners, people who are going to take the income from the fund for their retirement. So if you've got too many current and future pensioners and the liabilities they're accruing in their final salary, and that outstrips your assets, you're doomed, as they say. So you want to make sure that that balances it really well. What else did it do? It brought in the Pensions Regulator. So let's just put our little regulator in there for you. Very serious regulator. Regulators are always very serious, aren't they? There's your Pensions Regulator. Now, the Pensions Regulator is very different, of course, to the Financial Regulator, the Financial Conduct Authority. The Pensions Regulator looks after occupational pension schemes. OC schemes is what this regulator governs and makes sure adhere to the rules, etc., makes up rules for governance. So that's the Pensions Regulator. Not a lot more to say about that as well. The better one, as far as I'm concerned, one that's been in the press actually over the weekend, it created the Pension Rescue Scheme, or the Pension Protection Fund, as they call it. We've got a separate video on that one if you're interested. The Pension Protection Fund. And what this did cleverly, I guess, is it brought in a safety net for defunct pension schemes. So you have a company's gone insolvent, the pension money doesn't go. It used to back in the 90s, but not now. The pension money gets separate from the company's coffers anyway. So if the company goes insolvent, the pension fund will transfer itself to the Pension Protection Fund. So the money's not lost, it goes to the Pension Protection Fund, who then looks after it and manages it, etc. And they basically manage the money, so they look after it. They've got quite a lot of money under management, and they give guarantees, 100% guarantee for existing pensioners, and they give up to a 90% guarantee for workers who are contributing to the pension. But in most cases, it's pretty okay because the pension fund was unaffected. The problem, though, with that is if a company's gone insolvent, they probably weren't putting much money into the pension fund, which they're supposed to do, to balance it all off. That was the whole point behind it, because they were obviously using accounting methodologies to limit the amount of money they could put in because they were going to go bust. So you often found that the assets were less than the liabilities in many of these funds. So that's the one. What else did it do then? Different colour pen for you. Let's get a little bit of contrast going. They brought in more rules for pension trustees. So if you're really into the pension world now, pension trustees. Now, the pension trustees are the people, or organisation, of course, who don't manage the money. They employ people to manage the money, but they look after the whole pension itself. They look after the scheme rules. They make up the scheme rules. They have the trust rules as well. So if you ever talk to a customer and they've asked you for the scheme rules, or you've asked them for the scheme rules, the trustees provide those. It's usually an online form, which gives you the rules of the scheme. They also have the trust rules, which obviously determine how it's going to be invested and who's going to do the investing as well. So lots of issues around pension trustees, the people look after it. And the final one for you on the Pensions Act is the old OPRA. There you go. The Occupational Pension Regulatory Authority was abolished. There you go. And the Pensions Regulator came in to power. And that's pretty much an overview of the Pensions Act for you. Do you need to know much more than that for FSRE CeMAP 1? Not really. If you're doing the advanced DIP-FA paper, obviously you need to know a bit more. We've got videos on all these things, which if you're ever interested. So that's the Pensions Act of 2004. I bet that's changed your life. Bye. There you go. Nice one. Hope that's been useful for you. At least as an update. Remember, CeMAP 1 has had quite a few updates over the last couple of months, particularly during the summer. We've been spending a lot of our summer actually updating all our materials and our boot camps and things. So if you've done the old CeMAP 1, you really do need to get a CPD program going to update yourself, because there's been a lot of new things brought into the new CeMAP 1, which are relevant to mortgage brokers especially. So that's something to think about as well. Anyway, Let me give you 4 reminders of great coaching. If any of you are doing coaching, developing new people in your practice, here's 4 reminders for you on how to be a great coach. And possibly there's something new here for you. Number 1, match the coachee vigorously. Becoming like them will lubricate the communication that you're having. Listen and use their language and keywords. Note how much emphasis is put on their words and use these yourself. Some coaches note down the keywords on a piece of paper to use later when they're asking questions. Naturally, you mirror their physiology, their energy, eye contact. What about pace and tone of voice? Hand gestures can also be mirrored, but only when you talk. Number 2, create a presence. Start with a relaxed and open state of mind, with no barriers. When this state has been created, bottle the energy bubble and cloak it. Drape the cloak over the two of you. This allows you to block distractions even when you're in a busy hotel bar doing coaching. Tip number 3, sharing your ideas as a coach. See, many new or busy coaches find it painful to wait patiently and let the coachee's ideas percolate. Instead, they like to give their ideas or opinions. Strictly speaking, though, this is dangerous as the concepts become yours, not theirs, and they become reliant on you then. And if you're a sales manager, for example, that can be very dangerous. Leading questions are even more painful. Don't go there. Here's a few suggestions you can put into practice here. Challenge a different person to come out with some ideas. So ask the question, how would your playful self answer? Or how would your mentor respond to this question? Mentally step out of the coaching bubble and offer your idea, but give them an opt-out clause. Let's step out of our coaching session for a moment, shall we? As I've got some ideas to float past you. If they're not fruitful, we'll go somewhere else. Or, can I offer you my line of thinking? Or, let's step out for a moment. I have an idea. Would that work for you once you've given the idea? Number 4 for you, my final tip. Read the physiology, sense of time and challenge. Calibrate the person immediately when you meet them and observe for leakage. When you see it, challenge it. For example, watch their face closely and look for expression leaks and challenge them on the answers they're giving you. So there we have 4 great ideas to help you become a better coach than you are, particularly useful when you're coaching new recruits, new people to your business, and you want to let them take responsibility for many of the answers they give. Great. Okay, so there we have a little update there for you, a little coaching idea. As always, a couple of technical ideas for you, a coaching idea for you. Remember, all this is put into our mortgage CPD product, which is free at the moment for this year anyway. So you just need to get onto our database and find out more about that. That's in our website, archercourses.com, if you ever want to go there. As always, pop over to our database, get yourself on our database. Let's just put the details up there for you so you can scan that in or just key in the details. We'll put you on our database and we'll keep you informed of all things going on in the business. Other than that, my good friends, I hope you enjoy the rest of your week. It's my birthday the weekend, by the way. Just thought I'd mention that. Don't know why, just because I get excited with my birthday. It's one of those days I get very excited about every year. But I'll see you next Monday. Have a great week. Bye.